Welcome to Milken.
It's great to be here.
Absolutely. I mean, you are getting out of the house. I would think that's good for you. I would think that's good for your clients.
18 months, yeah.
Good for 18 months. And you have a relatively new job, a job you took over effectively during the crisis. That couldn't have been easy.
No, I've been with the firm for 18 years. My partner, David Samber, similar amount of time. So we both have grown up at Apollo. And yes, we were promoted about 2.5 years ago, right before the crisis. And I think all the discipline that we've maintained all of these years, because what we try and do is buy great companies, put less debt on them, help them grow, meant that we were able to withstand the shock really well. And so not only were we able to play defense, but we were able to play offense. We've committed 75% of our capital out of Fund 9. We're marked at a 49% gross IRR. So there have been challenges, but we're performing great.
Talk to us about the discipline when you're wanting to put on less leverage, when you're, though, seeing a wall of cash, money running, people wanting to lend, maybe in the private markets more than in the public markets or from the banks at the moment. Right. Why put on less leverage? Because
our whole philosophy is to buy good companies at lower prices, a fundamentally better risk reward. And so it's not always fun. You know, there is this momentum trade that has really, generated returns for growth. But over 31 years, we've generated a 39% gross IRR. So we're not sacrificing returns, right? We're fundamentally having a better risk reward because it's a high, better returns, less debt.
No one can quibble with the returns Apollo has seen, but when I hear you describe what is effectively a fundamental bottom-up type value trade, yeah. I would think a lot of people would look at that and say, why not chase after the more growthier opportunities? Why not?
So you have to think about what private equity is supposed to be. We're not supposed to generate or target returns quarter to quarter. We're supposed to buy good companies, have great management teams run them, and build value over the longer term. And so for us, that's always been our approach, to really create value for the longer term.
You've deployed, what, in excess of 10 billion?
Correct.
In the 12 months running to June 2021.
Right.
Is that the sort of discipline as well, or do you think that money will accelerate? Perhaps as we see more volatility in the market, more dislocations, will you be able to put more money to work? Or?
So within our flagship private equity business, we do corporate carve-outs, buyouts, and distressed. And I think what the last 2 years highlights is the benefit of that flexibility. So if you rewind the clock, kind of 2019, a lot of take-private transactions, that's where we were seeing the best opportunities. During the lockdown, we shifted very quickly to distress. We put $4 billion to work in distressed opportunities. And then as the market rebounded and the economy rebounded, we've really pivoted towards corporate carve-outs and take-private transactions again.
You're obviously at the top of your industry, but it is much more competitive than what it was when you started a couple decades ago. A lot more players in this. Go back and talk about how difficult it is to secure some of these deals when you're up against a Warren Buffett, when you're up against, some of your other competitors, Blackstone.
Right. So I think we have a very differentiated model, and we talk about trading complexity for value. And so when I think about the scale of our financial resources with Fund 9, that overlap of large and creative or large and complicated is a fundamentally less competitive part of the market.
Okay. But you still found yourself going up against Warren Buffett. And you won in that battle, in fairness.
Right. So a little bit of history. We did do the tech data. Take private. That was Thanksgiving of 2019.
And then M&A since then.
Correct. And so that's a great example where we signed the deal Thanksgiving. We closed in June of last year. So the most kind of difficult part of COVID and the lockdown was that period in between signing and closing. We worked with the management team to protect the business. We worked with the management team to protect employees. We never wavered from our commitment to the transaction. If anything, it really forged our relationship with the CEO. And then we got off to such a good start because of that fundamental approach that you referenced. We had such momentum that we were able to discuss the merger of Tech Data and Synex, which we completed earlier this year. We created TD Synex, #1 player globally in IT distribution. And again, I think that's a classic example of what we can do with our resources and our creativity.
And how long do you keep skin in the game? I mean, because you still, with that combined
we
unit.
still own 45% of the company. I think in general, tech data may be a little different, but in general, we still target holding investments for about 4 to 6 years on average.
And can I follow up? When you were just saying, now you're thinking about carve-outs that much more.
Right.
When do we go back to the distressed opportunities? Because we're starting to talk of the Fed pulling back on stimulus. Do we start to see some of these zombie companies actually get into distress, actually have an issue?
It's so interesting you mentioned that because I love talking about that stat. 20% of the S&P 500 last year were zombie companies, which is hard to believe.
Yeah.
And so what we are seeing is that companies want to shed assets, narrow their focus, pay down debt.
So we saw Verizon do, for example.
Correct, when we acquired Yahoo from Verizon. And so we've been a partner of choice in these large, complicated corporate carve-out transactions. And so I think there's going to be opportunities for that. And then I think other equity solutions, creative opportunities, given the amount of leverage in the system.